Do you think you can fundraise just because of your recurring revenue? Well, sure, investors care about your annual recurring revenue, but there are two metrics that they care about even more. And those are metrics that a lot of founders have actually never heard of. And if those two metrics are off, your ARR won't save you. Let's take a look at what a typical SaaS company dashboard looks like. So we have our ARR, we have MRR, we have churn rate, NRR, LTV, CAC, pipeline burn rate, NPS, a lot of numbers. And, I know most founders track all of them, even religiously, weekly reviews, board decks, investor updates, the whole thing. So let me show you what the hell is missing. By the way, if you're new here, my name is Roland Umlauft. I am a startup CFO and strategic advisor, and I have spent close to 2 decades working on innovation projects across early and growth stage companies. I've sat across the table from investors. I've built those financial models for fundraisers, and I have seen firsthand what those conversations look like. So today, I'm going to give you 2 KPIs that most founders either don't track or they quietly ignore them. And both of those KPIs have an impact on your valuation. So let's get into it. The first one is called the Rule of 40. So you add your year-over-year revenue growth rate to your free cash flow margin. And if that number hits 40 or above, then you're in great shape. Below 40, not so much. That's a problem worth fixing before you go into your next fundraise. Why does this metric matter? So SaaS companies, they're constantly reinvesting into growth. What does that mean? This means that they're typically not generating net profit, but instead they're generating growth. Theoretically, if you think about it, they could choose to stop growing, stop all investment into customer acquisition, and they would probably be very profitable right at that point, right away. So, how do you assess if their growth is balanced, if that trade-off of giving up profitability today for acquiring future growth, if that trade-off is really balanced? And this is what the Rule of 40 does. And it will reflect in company valuation. Companies that consistently score above 40 are valued at a significantly higher revenue multiple. The best SaaS businesses at their peak, they're pushing scores of 60, 70, maybe even 80. Let's go a little bit into the technicalities of the Rule of 40, of how to calculate it properly. Why am I saying free cash flow margin and not EBITDA, I hear you asking? Well, actually, you'll sometimes see this formula written with EBITDA margin instead. I prefer free cash flow margin, and I will tell you why. When we look at EBITDA, we're ignoring capital expenditures, which I hear you, SaaS companies are CapEx lean, so this shouldn't be a big issue. But you can game EBITDA by capitalizing your R&D costs. So all those salaries you're spending on R&D, you're treating it as an asset instead of an expense, which increases your EBITDA margin. So free cash flow, on the other hand, doesn't care about any of that. It just looks at, cash in versus cash out. It's much cleaner, it's much harder to manipulate, and it's increasingly what you should be using. How do we calculate free cash flow margin? Well, it's nothing else than free cash flow divided by revenue. Simple, right? So what should we use for revenue? Best would be to use your GAAP recognized revenue and not your billing number. So that is a number that is adjusted for those, prepaid annual subscriptions, for example. This would be the standard that your investor would expect. It's auditable. It makes your number comparable to the benchmark. It is what you should be using. Now, let me show you two examples of two companies and their Rule of 40 number. The first one, we're imagining a company that is growing at 50% and it is loss-making. It has a free cash flow margin of minus 15%. Well, 50 plus a negative 15 gives us 35. We're below 40. So we should be watching out. On the other hand, we have a second company, lower growth rate, 20%. That company is profitable. They have a free cash flow margin of 22%. So adding those two together, we're getting 42. We're above 40, solid business. Both are totally different business profiles. One is a high growth company that is burning a ton of cash. The other one is slower, but it's profitable. The Rule of 40 doesn't actually care which path you're taking. It just asks, are those two sides of your business adding up to something sustainable? So, what to do if you're way below 40? Well, it depends what kind of company you are. If you're an early stage company, you should be really leaning into your growth. So try to invest more efficiently in growing your pipeline. Try to expand your revenue inside your existing accounts. And maybe try to shorten your sales and onboarding cycle. On the other hand, if you're a late stage company, you should really try to, tighten on efficiency. So try and cut out any low ROI spend, especially on your sales and marketing spend. Also, take a look at your direct costs or COGS. For example, maybe you tighten up your support functions a little bit, maybe you automate them, something like that. And finally, you can always try and look at raising prices, especially in your core tier. A 1% price increase can improve your net profit by up to 11 points. So, are your customers really going to drop you because of a 1% price increase? Try maybe, 2%, 3%, 4%. You can squeeze a lot of additional net profit out of a small price increase that hardly anybody will be noticing. All right, KPI number 2. This one, I think, is even more underappreciated. And we're talking about CAC to new ARR ratio. This tells you how efficiently are you buying your revenue. The formula is CAC, so total sales and marketing spend divided by the new annualized recurring revenue that you have added. So this means that you're measuring for every dollar you're spending on sales and marketing, how much in annualized new revenue are you getting in return? So let's say you've spent $2 million on sales and marketing and you added $1 million in new ARR. That gives you a ratio of 2x. So is that a good number? Well, let me show you a rough benchmark. Below 1.5 is excellent. You're getting, more than $1 of ARR for every $1.50 you're spending. 1.5x to 2.5x is a healthy level. And if you're above 3x, you're probably paying a little too much to grow. Now, this ratio will naturally be higher when you're early stage and, while you're still figuring out your go-to-market playbook, and that's perfectly fine. But as you are scaling, if this number isn't coming down, That's a sign that your sales efficiency is low, even if your top line ARR is looking great. Here is why this metric often gets ignored. Well, ARR goes up, it feels great. You're closing big deals, the number is, going up every month, the team celebrates. But if you're spending 4x the amount that you're adding in revenue to close those deals, you're likely going to be destroying value in the long run instead of creating it. Your potential investors, they will be caring about this number because it is a great indicator of capital efficiency and scaling. Let's compare it to other metrics. So, for example, everybody's looking at the LTV to CAC ratio, for example. LTV is often a rough estimator, and it is very hard to measure realistically. Also, it doesn't tell you anything about capital efficiency of your growth. You will need to combine it with a second metric, something like payback period, for example, to even begin to estimate how much more money you have to deploy in order to grow. So using CAC to new ARR is much easier. Just take your sales and marketing spend, divide it by the new ARR, and immediately you know whether your growth is efficient or if you're buying growth expensive. What happens if your ratio is too high? Well, a couple of things can happen. On one side, probably your sales cycle could be too long, so you're paying your reps to work deals that are just not wanting to close. You could also just literally be addressing the wrong customer segment or ICP, so you're targeting companies that are churning out or they're taking forever to buy. Oftentimes, you could also have a problem that, your marketing isn't actually generating a real pipeline. So your reps are tied up spending, time prospecting instead of closing deals. And one other reason could be that, average contract value is maybe too low for the sales effort that you're putting in. In other words, if you're using an enterprise sales team to sell a 5K product, then you're probably going to see a really, really bad ratio. The fix to your ratio is almost always one of those. So find it and fix it, and that ratio should start to improve. Let's see how I think about using those two metrics together. On one side, the rule of 40 tells you about the overall health of the business. So it's the balance between growth and profitability at the company level. On the other hand, the CAC to new ARR ratio tells you about how efficient you are in your growth engine. So how efficient does your growth engine run? Remember, you can have a great rule of 40 score, which is probably built on some existing customers, maybe some, expansion revenue that you're getting. But if your CAC to new ARR ratio is terrible, you will have a growth problem about to surface. So running both of those metrics at the same time gives you a much, much clearer picture. So I invite you to calculate both numbers, rule of 40, take your year-on-year growth rate, add your free cash flow margin, calculate your CAC to new ARR ratio, take last quarter sales and marketing spend, divide it by the new ARR added. So subscribe if you want more startup finance insights like this. And please drop your scores into the comments. Rule of 40 and CAC ratio. Let's go. Let's see what those real numbers look like out there.